The Strait of Hormuz could drag Britain back into a cost-of-living crisis. Britain faces recession if the Strait of Hormuz remains closed. Britain's economy may have survived the first months of the Strait of Hormuz crisis, but a prolonged closure could transform an energy shock into a recession, another inflation surge, and a renewed assault on household living standards. The warning is no longer confined to worst-case geopolitical speculation. EY's latest UK economic forecast estimates that if the Strait of Hormuz remains effectively closed into early or mid to 2027, the British economy could contract by 0.2% next year. Growth in 2026 could slow to approximately 0.5%, while inflation could climb to 6.4% by the end of this year. That would leave Britain facing the most politically dangerous kind of downturn. Not a conventional recession caused by collapsing demand, but a period of stagnation accompanied by rapidly rising prices. In other words, stagflation. The distinction matters. During an ordinary slowdown, the Bank of England can usually support the economy by cutting interest rates. An energy-driven inflation shock makes that response far harder. Lower rates might stimulate spending, but they could also intensify inflation and weaken sterling, making imported fuel and goods even more expensive. Britain is therefore being squeezed by events thousands of miles away, at one of the narrowest and most strategically important shipping corridors on Earth, the world's energy artery. The Strait of Hormuz connects the Persian Gulf to the Gulf of Oman and the wider Arabian Sea. It is only around 24 miles wide at its narrowest point, yet it normally carries extraordinary volumes of global energy. During the first half of 2025, approximately 20.9 million barrels of oil and petroleum products passed through it each day. That was equivalent to about one-fifth of global petroleum consumption. The strait is equally important to the liquefied natural gas market. Around 20% of worldwide LNG trade passed through Hormuz in 2024, overwhelmingly from Qatar and the United Arab Emirates. That concentration makes Hormuz more than a regional waterway. It is a physical switch embedded in the global economy. When it operates normally, oil tankers and gas carriers move between Gulf exporters and customers across Asia, Europe, and beyond. When passage becomes dangerous, unpredictable, or commercially impossible, the effect is transmitted rapidly through commodity markets, insurance premiums, transport costs, and inflation expectations. The strait does not need to be sealed perfectly to cause severe disruption. It only needs to become dangerous enough that shipowners, crews, and insurers are unwilling to accept the risk. Commercial traffic is currently heavily restricted, with intermittent movements occurring under dangerous and uncertain conditions. Reuters reported on the 3rd of August that Iran was discussing temporary safe passage arrangements with Oman, while Tehran maintained that the route could not fully reopen while the wider conflict continued. The central economic question is therefore not whether an occasional vessel can pass. It is whether energy can again move through the strait reliably, safely, and at something approaching its pre-war scale. Why? Britain is exposed. Britain does not need to purchase all its oil or gas directly from the Persian Gulf to suffer. Energy is traded through global markets. When a large source of supply disappears, buyers compete for what remains. Prices rise everywhere, including in countries receiving fuel from different producers. The effect then spreads far beyond petrol stations. Oil is used to move food, manufacture plastics, power construction equipment, operate aircraft, and transport goods between warehouses, shops, and homes. Natural gas influences electricity generation, industrial processes, fertilizer production, and household energy bills. A sustained increase in energy prices, therefore, works its way through almost every part of the economy. Haulage companies charge more to move products. Farmers pay more for fuel and fertilizer. Airlines face higher operating costs. Manufacturers spend more on energy and raw materials. Supermarkets eventually receive higher prices from suppliers. Businesses then face three unpleasant choices: absorb the additional expense through lower profits, raise prices for customers, or cut investment and employment. Many eventually do all three. This mechanism was already visible earlier in the crisis. The Bank of England reported in April that the UK wholesale gas futures curve had risen by an average of roughly 37% following the conflict, while oil prices had approached levels seen after Russia's invasion of Ukraine. The bank has also warned that energy shocks can create broader inflation if firms pass higher costs through supply chains and workers demand stronger wage growth to protect their living standards. That is how a temporary rise in fuel prices can evolve into something more persistent. The recession scenario. EY's central forecast is not that recession is inevitable. Its more optimistic scenario assumes that meaningful traffic through Hormuz resumes by the end of September. Under that assumption, EY expects the UK economy to grow by about 0.8% in 2026 and 1.2% in 2027. Inflation would still rise, but the shock would begin to fade before it caused lasting economic damage. The recession scenario begins when the disruption persists into 2027. EI estimates that an extended closure could push oil back above $100 a barrel, keep gas prices severely elevated, and drive inflation toward 6.4% by the end of 2026. Growth would weaken sharply this year before GDP contracted by 0.2% in 2027. A contraction of 0.2% may not sound catastrophic. It would not resemble the sudden collapse experienced during the pandemic or the global financial crisis. But headline GDP understates the pressure felt by individual households. Britain's population is growing. If total output falls, while the number of people rises, output per person declines more severely. Families can therefore feel materially poorer, even when the national GDP figure moves only slightly. The damage would also be uneven. Lower-income households spend a larger proportion of their income on heating, electricity, food, and transport. They possess fewer savings with which to absorb another price shock. Energy-intensive businesses and companies dependent on discretionary consumer spending would also face disproportionate pressure. The recession might appear shallow in the official statistics while feeling deep in kitchens, factories, and high streets. The interest rate trap. The Bank of England's problem would be brutal. Inflation caused by expensive imported energy cannot be solved directly by raising British interest rates. Higher borrowing costs cannot reopen a shipping lane, remove sea mines, or produce additional barrels of Gulf oil. Rate increases work by suppressing demand elsewhere in the economy. Households spend less. Mortgage costs remain elevated. Businesses delay borrowing and investment. Employment demand weakens. The bank would effectively be attempting to offset imported inflation by creating additional weakness at home. Cutting rates would carry the opposite danger. It might provide relief to borrowers and businesses, but it could also allow inflation expectations to rise and put downward pressure on sterling. The bank held its key rate at 3.75% in July, as policymakers weighed weaker domestic inflation against the risk of another energy-driven surge. Under EY's central scenario, interest rate reductions could begin in 2027. A prolonged Hormuz shutdown could delay that relief or force policymakers to consider tighter conditions even as the economy weakens. That is the definition of a policy trap. The government would face a similar dilemma. Subsidizing fuel or energy bills could protect households, but it would increase public borrowing. Cutting fuel duty would reduce Treasury revenue. Supporting affected industries could prevent closures while also transferring a larger share of the crisis onto taxpayers. There is no painless intervention. Britain is not starting from collapse. The recession warning should still be treated as a scenario, not a certainty. Britain entered the second half of 2026 with more resilience than some of the darkest commentary suggests. Official figures show that real GDP grew by 0.6% during the first quarter of 2026. Output in the 3 months to May was 0.7% higher than in the preceding 3-month period and 1.1% higher than a year earlier. Manufacturing also continued expanding in July, although the pace slowed and employers became increasingly cautious about geopolitical and energy risks. The country is, therefore, not currently in recession. Nor does one forecasting organization's adverse scenario prove that a downturn will occur. Energy markets can adjust. Consumers reduce consumption. Producers outside the Gulf increase output. Governments release strategic reserves. Businesses alter supply chains. Diplomatic agreements can lower insurance costs even before traffic fully normalizes. The United States Energy Information Administration has already projected a fall in global oil consumption during 2026 as high prices and restricted availability suppress demand. That response reduces some pressure on limited supplies, although it also reflects weakening economic activity. The strongest counterargument to the recession warning is therefore that markets are adaptive. The initial loss of supply does not translate mechanically into permanent shortages of equal size. But adaptation is expensive. Demand falls partly because people and businesses can no longer afford to consume as much. Alternative oil travels farther. Insurance remains costly. Industrial production may be reduced. Some companies do not survive long enough to benefit from eventual stability. The economy adjusts, but not without casualties. Diplomacy has become economic policy. The most important decisions affecting Britain's near-term economy may now be taken in Washington, Tehran, Muscat, and Gulf capitals, rather than in London. Iran has acknowledged discussions with Oman over a temporary passage arrangement. President Donald Trump has also spoken publicly about negotiations intended to address the strait and the wider conflict, although Tehran has disputed claims that direct U.S.-Iran talks are already underway. Markets reacted positively to the possibility of an agreement, demonstrating how much of the oil price currently reflects anticipated future danger rather than only immediate physical supply. A credible reopening plan would need more than a political announcement. Shipping companies would require confidence that vessels would not be attacked or seized. Mines and other navigational hazards would have to be addressed. Insurers would need to restore commercially viable cover. Naval escorts, monitoring arrangements might be required. Gulf exporters would then need time to rebuild normal production, loading, and delivery schedules. The difference between announcing that Hormuz is open and restoring reliable commercial transit could be measured in weeks or months. That is why Britain's economic outlook now depends on duration. A short disruption creates a painful inflation spike. A prolonged disruption begins to change wage demands, investment decisions, interest rate expectations, and corporate survival. Eventually, the energy shock stops being an external event and becomes embedded in the domestic economy. Britain's warning from history. Previous energy crises show that the greatest danger is rarely the first price rise. The deeper damage emerges when uncertainty persists. The oil shocks of the 1970s combined weak growth with inflation and forced governments to reconsider energy security. The 1990 Gulf crisis produced a shorter, sharper disruption. The surge in oil prices during 2008 amplified existing financial and household pressures. Europe's break with Russian energy after 2022 contributed to inflation, public subsidies, and a profound reassessment of strategic dependence. The pattern is examined in the history of the world's biggest oil crises. Energy shocks become political and economic turning points when countries discover that efficiency has been purchased at the cost of resilience. The present crisis has already begun rewriting Britain's economic assumptions. Cheap and predictable access to global energy can no longer be treated as a permanent background condition. Hormuz also remains central to the strategic balance of the Iran war. Iran does not need to defeat the United States or its allies conventionally if it can impose economic pain through the world's most important energy choke point. That leverage is now reaching British households. Britain does not face recession simply because one forecaster has published a gloomy model. It faces recession because an already fragile import-dependent economy has limited room to absorb another prolonged burst of inflation. If Hormuz reopens securely in the coming months, the country may escape with weak growth and another temporary increase in living costs. If it remains effectively closed into 2027, the crisis will no longer be a distant war disrupting a distant shipping lane. It will be a British economic emergency.